Today for the BPA project, I'm going to be doing the next chapter in trading price action trends. So today is chapter 3, which is breakouts, trading ranges, tests, and reversals. And I just want to reiterate that this is my perspective and my experience with Al's material. This is all Al's material. I highly recommend reading his books, getting his course, and getting the material directly from the source. This is just a supplement. So in this chapter, it's pretty short. I think Al made this chapter so that the reader understands the terms breakouts, trading ranges, tests, and reversals as he talks about them throughout the chapters. But there's a large section about breakouts in chapter 2. In book 2. There's a whole book about reversals in book 3. So the concepts go a lot more in depth in the future, in future chapters. But he just introduces the topics here briefly. So I'm going to do the same and talk about these 4 topics and explain them as he has. So he starts off by saying that breakouts and the ability to distinguish between a successful and a failed breakout is one of the most important skills for a trader. And in chapter 2, he said the same thing about trend bars. He said one of the most important skills for a trader is to know when a trend bar is going to lead to a trend and when it's going to lead to a successful breakout and when it's a trap and when it's going to lead to a failed breakout. And because all trend bars can be seen as breakouts, the same goes for breakouts out of a trading range. It's important for us to be able to distinguish when this breakout is going to lead to a new trend and when it's simply going to be a failed breakout and a reversal. And so in general, a breakout is a trend bar. It can be large or small, but it's a trend bar outside of some structure, and it's followed by many trending bars in that direction. So it forms a spike. And so here we have a swing down, a swing up, but as soon as we get up to the high of day, the bar 3 high, we get a large trend bar on 38, followed by a follow-through bar. And then after that, we get multiple trend bars closing near their highs. So that's a breakout out of this initial opening range. It's a large opening range, but it's a clear breakout and follow-through outside of that range with multiple trend bars in that direction. So this is multiple trend bars forming a spike, and that's a breakout outside of a range. And a trading range is an area of two-sided trading. So whereas a breakout and a trending market is one-sided, where there's mainly one side overwhelming the other side, a trading range is where both sides feel comfortable placing trades, and they both find value in those prices. And so to explain breakouts and trading ranges, he uses the example of a spiking channel trend. So here we have the initial breakout, and we have multiple trend bars. It's clearly one-sided. We're only getting bull bars. But then as the trend develops, as the breakout develops, we get a bigger bar. And this is kind of a review from chapter 2, is that we have a trend bar here on 38, and then a pause, and then a 2-bar breakout, and then a smaller bar and a pause, and then one final breakout and a pause. And in chapter 2, he mentions that a pause ends a climax. And so this can be seen as consecutive climaxes, 3 climaxes up with the final biggest bar to end the climax, the overall breakout. And so it makes sense after consecutive climaxes and consecutive pauses that we could start to get a pullback. Once the breakout has gone on long enough and the pullback, and we start to get a pullback, it's probably not a reversal. It's probably a pullback before a subsequent leg up. And when that trend resumes, it's more likely to have two-sided trading rather than be another strong spike up like this. So we get the pullback from the spike, and then the second leg up, the rally after the spike, often has both bears and bulls willing to place trades. And so you can see the quality of the rally is much different here than it was here. Here we had all bull bars. We had gaps in between bars. So we had the low of one bar above the high of the breakout point. And that keeps happening because bulls are buying aggressively. Whereas here, every time we break above a swing high or break above a bar, we get back below it. And we have a lot of alternation. We have a bull bar and a bear bar, a breakout and a bear bar, breakout and a bear bar, breakout and a bear bar. So we have a lot more two-sided trading here. And you can see that the pace is also different. This is almost straight up, whereas this, you can see the slope is much less steep. And that's because the slope is going to change when the bears are asserting themselves more. And so they're able to change the slope of the trend. So more bear bars, more tails, more overlap shows signs of two-sided trading. And so because this second leg up from the spike has more two-sided trading and more trading range behavior, Al calls this a bull leg in a trading range. So even though it's clearly trending up, it's trending up with a different quality. It's trending up with both sides willing to take trades and both sides seeing value. And when both sides see value, if they're seeing value all the way up, then it's reasonable for it to test back down to those value prices. Here on the way up, only the bulls were seeing value. They were buying aggressively and they were overwhelming any bears. They were willing to buy at higher prices. Whereas here, bulls were still on average overwhelming the bears because the trend was still up, but it was clearly more two-sided and both sides were willing to take trades and were seeing value in those prices. And so it makes sense for if bears were finding value down here and the market's always looking for value, it makes sense for it to retrace all or most of the channel. And that's typically what happens. Once we start to get a bull leg in a trading range, it's common for it to break below that bull channel and retrace the channel and come back down to the bottom of the bull channel. And so Al gives the example. He doesn't talk about trading much in this chapter, but he says as an example, once we get the first pullback, bears will know that the next leg up will probably have more trading range price action, and they'll start to sell. They'll start to sell above bars, they'll start to sell below bars, knowing that the bears will find value. And once we break below the channel, they'll start to add more, and they'll finally take profits down here at the bottom of the pullback, knowing that once we're up here, because it's a spike in channel trend and that this is a bull leg in a trading range, they feel confident that we're going to test back down to lower highs and potentially retrace the entire channel. So they feel confident scaling in to the upside and then taking profits down here. And so bears will take profits on their shorts down here at the bottom of the channel, and bulls will start to buy at the bottom of the channel. And that's what will cause a bounce. Once we get the bounce from the bottom of the channel, Al says the spiking channel has played itself out, the pattern has played itself out, and the traders will look for a new pattern to develop. And these spiking channel trends, they happen on multiple different scales. It's just a principle of the market that once we get an initial spike, we'll eventually start to get two-sided trading, and that initial spike will start to fizzle. And so here's an example on a different scale. We have a double bottom bull flag here, and we get a strong breakout, 2-bar breakout above the moving average. And this is still a strong rally, and we're still part of this breakout. But you can see that after the strong 2-bar spike, we start to get a bear bar, tails, and overlap. And so within this breakout, we have a spike and a small channel. And this channel is showing us two-sided trading. The tails are showing us two-sided trading. Both sides are willing to place trades. And that's the quality of these 5 bars are very different than the quality of these 2 bars. It's just a strong spike up, a lot of overwhelming buying. And then here we start to get two-sided trading. And here you can see that the channel was retraced. We got to the bottom of that small spiking channel, and then we bounced. And the same is true for the bear case. Here we have a bear spike. Now this has some tails and some bull bars, but because it's so prolonged, it's probably a breakout on a higher time frame. So we have a spike on a higher time frame, and then we have a channel. And you can see after the first pullback, the pullback is deep, and we start to get a lot more overlap, a lot more bull bars on the way down. And you can see the pace as well has changed. This is a strong spike down, and now the slope has changed. It's a change in pace and a change in quality. And this bear channel eventually breaks to the upside and retraces the channel, because this is a sign of two-sided trading. And so because these channels typically get retraced, Al says it's useful to look at all bear channels as bull flags and all bull channels as bear flags. So here, this is a bear channel. It's clearly trending down, but because there's two-sided trading, Al says to treat it like a bull flag that's going to break to the upside and retrace to the top of the channel or most of the channel. And for the bull channel here, in this example, treat this bull channel as a bear flag. It should break to the downside and retrace that bull channel. He mentions here briefly, but he talks about it a lot more later on. But he mentions here briefly that sometimes a bull channel will break out to the upside instead. And so here we have a really strong spike up above the moving average. And you can see that on this spike up, every time a bar breaks above the prior bar's high, the pullback on the next bar does not get below that breakout point. So it's a very strong breakout. After this first pullback to the moving average, the quality of the second leg up is much different. After every breakout above the prior bar's high, we get a bear bar or a tail. So here we have a breakout above this prior bar's high, or the prior minor swing high, and we got a bear bar. And we got a breakout and a big tail. We got a breakout and a bear bar. The quality is much different. This is a spike in channel trend. And you'd expect the spike in channel trend to break below that channel and for this to act as a bull channel or bear flag and break to the downside. Here we got the upside breakout. But Al says that when the channel breaks to the upside, there's a 75% chance that it's going to fail within 5 to 10 bars. So most bull channels, if they do break to the upside, they'll probably fail very soon, instead of breaking out and then resuming an even stronger trend up. That's much less likely. He talks more about that later, but he just gives a brief overview of it here, that most bull channels will break to the downside, most bear channels will break to the upside. And here, in a bull channel, if we do break to the upside, it'll probably fail. And in this case, it failed after 2 legs up, got back within the channel, eventually broke below it, and retraced the entire bull channel. And here's an example of a bull channel, tries to break above the upside, 2 legs, fails, and then eventually retraces the entire bull channel. And so one important consideration that Al mentions is that traders need to be able to accurately characterize when the channel is a bull leg in a developing trading range, or when it's very tight and possibly a spike up on a higher time frame. And so if the channel up is very tight and the trend is strong, so here we have a spike 18, 19, 20, 21, we get the first pullback, and now we're getting a change in quality, a change in pace, but it's an extremely tight channel. And when we broke below the channel here, it just went sideways for a couple bars and then continued to break higher. So when the channel is tight, it's possible that every break below the channel will just lead to a bull flag that will continue higher until the pullbacks start to get larger. So that's the example he gives for breakouts and trading ranges. Now for tests. A test is when the market returns to an area of support or resistance. And so based on a test of support and resistance, traders will often place trades depending on the behavior of that test or how the market acts around those levels. And so some test location examples that he gives are yesterday's open, yesterday's high, yesterday's low, yesterday's close, a trend line or a trend channel line, a measured move target or a breakout point, a swing high or a swing low, a bull entry bar low or a bull signal bar high, a bear entry bar high or bear signal bar low. And I'll give some examples of these. They'll be talked about a lot more later on in the books, but I'll give some examples of these here. And to start off, I'll give an example of a trade I took this week that in hindsight ended up being pretty dumb, but I saw this as 2 legs up in a trading range day and then a break below the moving average, strong breakout below the moving average, and so I sold here. But this breakout below the moving average and breakout below the double top was actually just a test, and it was a test of a trend line. And so I haven't been using trend lines much, and mainly that's because in Al's room he often doesn't draw every trend line, and so I've kind of developed a bad habit of trying to trade above my level and not have trend lines on the chart. And this is such an obvious one to be able to avoid just by having this easy trend line at the bottom. But just to show an example, this is a test of the trend line. And I asked Al about the trade. He said, yeah, it wasn't a good trade because it's shrinking bodies, which means it's losing momentum into the bottom of a bull channel. So the momentum is weakening into support. And that's an example of seeing the behavior into a test. This is testing the trend line, and the momentum is decreasing. Once we get the bull bar, it confirms the trend line, and that ended up being a swing buy up to a high of day. Along with being a test of the trend line, this was also a test of the buy signal bar after the breakout pullback. And so, as I mentioned here, a bull entry bar low or a bull signal bar high. So in this case, this is the signal bar, and it's not a good signal bar. But when you get a signal bar that leads to a trend or leads to a rally, the market will often come back down and test the actual signal. And so here it was a breakout pullback, and this is the signal bar. And it's not a bull bar, but it is the signal bar for the bulls. and you can see the market came back and tested it. The same thing happened here. We had a double bottom bull flag, and this was technically the signal bar for the rally. And this move down was actually a test of that signal bar high and led to a rally. So here we have two clear tests of the signal bar high that led to the rally, and it was a perfect test that led to a new high. This red line is a three-legged move up to the open of the day. It's a test of today's open. And Al actually said after the reversal down and 3 pushes up that it was a reasonable sell below 34, betting that we would come back down and test the breakout point, which is another example of a possible test. So there's a lot of ways to use tests to place trades. And if you think a level is going to be tested and you get a reasonable setup, then you can trade looking for that level to be tested. That's more advanced. Even I struggle with that right now. But these are some examples of tests in common areas. And here's another example. Bar 18 here is a buy signal bar. We had a strong rally from that, and we came back down and tested that buy signal bar high and got a bull signal bar. That's a reasonable buy. Then we got up to a new high, came back down and tested this buy signal bar high, tested it to the tick almost, and then rallied to a new high. So these tests can create a lot of opportunities if we can read them correctly. Here's another example of a test. It's a possible buy the close rally. Bulls will buy these closes. When they're disappointed by 29 and 30 and this sell-off, when the market gets back up to the high close, if bulls are sufficiently disappointed, they'll exit at the high close test, and that led to a sell-off, which eventually led to a swing down. Here is a bear example. We had a breakout and a test of the breakout point. And then here we had a rally up above the moving average. So this is a major trend reversal opportunity. And so once we break above the moving average in a bear trend, the bears will see how it acts at the extreme. So it's acting as a test of the swing low. And bears will start to take profits when they see that the test of the swing low is weak, and bulls might start to buy. And that can lead to a major trend reversal or a trading range. And that leads us to the last topic, which is reversals. So the most common use of the term reversal is to describe a change from a bull trend to a bear trend, or a bear trend to a bull trend. But Al uses this term a little differently. He uses the term reversal to describe a change from one type of behavior to the opposite type of behavior. So he argues that trading range behavior is the opposite of trending behavior. And so when he talks about major trend reversals, for example, it's an opportunity to reverse the trend from a trending environment to a trading range environment. So that's why the major trend reversal example, when we have a major trend reversal, it doesn't mean that the trend's actually going to reverse. It just means that we're going to reverse the trending behavior and possibly enter a trading range environment. And so here's where Al introduces the topic that markets have inertia. And so when we have a bear trend, anytime we try to reverse, it's probably going to become a trading range and a bear flag. And so here we tried to reverse, but it became a bear flag. Here we tried to reverse, it became a bear flag. Here we had a stronger reversal that also became a bear flag. And so markets are constantly trying to reverse, but because the market has inertia, it wants to keep doing what it's been doing. And so when it's in a trend, it's going to try to keep trending. And most reversal attempts will become trading ranges and flags in the same direction of the trend. As the trend continues though, the pullbacks will start to get deeper and deeper. So here the pullback doesn't quite reach the moving average. This one does, and this one actually breaks above the moving average. So the pullbacks are getting deeper and deeper. The bulls in this case are starting to assert themselves more and more. At some point, the bulls will assert themselves enough to get a bull breakout of the trading range and actually reverse the trend. But that's going to come after many failed attempts by the bulls. And most pullbacks will just become bear flags. And Al's entire third book is on trend reversals. So there's going to be much more detail on this later. This is just a brief overview, as I mentioned, just to make sure that we have the terms down. So those are the 4 main topics that he gives the overview on. And I hope you found it helpful. Please let me know if there's anything that I can make more clear, or if there's anything I can do in the way I'm explaining things to make it easier to understand or more clear. So thanks for watching, and please let me know if it was helpful and if you have any questions.